So glad to have everybody here. I'm Jenny Anchondo. It is time for another SARE National session. It's actually part two of a two-part series that we started last week, but don't worry if you didn't catch last week's. The replay is actually out on SARE's YouTube channel already, and that will be available after you're done today. So you will still, even if this is your first session, you'll still be able to get a lot out of it. So we are really excited to have Jose Puente with us again. This is Financing Your Business 102. Last week was 101, today's 102. So we'll have a little bit of review today, and then we'll also continue on just so that we can continue to learn and become educated. And, listen, so many of you are coming in here with dreams of a business, or perhaps you already have your business underway. And it's like, oh, I have my passion for my business, but there's a whole other component, and it has to do with financing it and actually, getting it off the ground and making sure that it's sustainable. So that's some of what we're going to chat through with Jose. So, okay, who is this guy? Who is this Jose that we heard from last week? He is a retired financial executive. I mean, he has more than 40 years in corporate finance, international trade finance, treasury management, and new business origination. So he's done a lot in the business realm and in the financial realm. He's managed acquisitions, equity investments, various forms of debt facilities. He also has really diverse experience. So I know some of you are new to the US, new to doing business in the US. Perhaps you come from other parts of the world. He has experience in the United States, Latin America, Asia, Europe, Africa, also really diverse industry experience. So, sometimes you hear from somebody and they've really been on one track and you think, I don't know if they'll be able to help me or advise me. Okay, he's kind of done it all. Consumer products, energy, capital goods, agricultural commodities, metals, mining. So like I said, he has done it all. He's worked with large public companies like PepsiCo and United Technologies, also some smaller private companies as well. Also very important to mention, he is fluent in both English and Spanish. That's his native language, and is a Wharton MBA. I am in Texas. He happens to be in Texas as well, and in North Texas, has 3 daughters, Madeline and Carolyn, and then Jacqueline, who happens to be a SARE board member. So I just love the family connection that brings all of that together. So here's the plan, you guys. He's got a great presentation prepared for us. Last week's was really, really helpful. I took a lot of notes myself. I know many of you did as well. So this is part 2 as he continues to engage with us. But again, if you weren't here last week, no big deal at all. You'll continue to be able to learn, and then you can catch the replay. All right, I'm going to mute myself.
Thank you very much, Jenny. Appreciate that introduction. And welcome all of those who were here basically last week, and welcome to those who are new. As Jenny said, one of the benefits of being retired is that you can do what you want to do, and the reason why I have 40 years of experience is because I've been around the block a couple times, so it's not it's not unusual. But anyway, I want to start off I want to start off the same way I started off last week. For those of you that didn't have the opportunity to listen, is that financing, there is no cookie cutter solution to financing. There's no magic sauce that guarantees you getting a loan from a lender. Every lending institution has a different risk appetites. They all have different loan processes. You may think that the SBA may be an easier process to get a loan than it is from a regular bank, from a conventional, commercial bank. That may be true if you have a specific situation that is attractive or that qualifies for that SBA financing. But otherwise, the procedure at the SBA is the same procedure. The procedure that the SBA requires commercial banks to follow is basically the same as a commercial bank. The SBA makes the risk appetite change. The U.S. government is prepared to guarantee the loan because you're in of a certain sort of ethnicity, or you're in a business that has an economic impact that's somewhere where where the U.S. government or the government wants that economic impact, and that's basically what it is. But the process is the same. So if you think that I'm going to give you a magic solution, or if you think that the SBA is a magic solution, you're mistaken. You really need to go through the process. And that's what I hope to do today, is kind of recap some of the process that we went over last week on, and talk about three specific types of financing that I think may be helpful to a smaller business, as you know, that is looking to develop its sourcing, funding. So again, it's a recap of last week, and then looking at specifically transactional financing, as I call it. Now, transactional financing has different names. Some people refer to it as working capital financing. Some people refer to it as trade finance. I call it transactional because, as you will see, it is all based on a specific transaction that you're doing that results in the bank or the lender becoming involved with, and it sort of self-liquidates itself when your customer pays that, makes a payment for your account. So it's automatically unwinds. You get a loan, you get an advance, and it automatically unwinds as the underlying transaction gets to its final point, which is basically the repayment from the customer. So keep that in mind, and we'll see that in some of the descriptions that I'm making, some descriptions that I'll have later on. Okay, let's do a little bit of a recap. What do you need to consider before you start looking for financing? Well, the first thing you need to do is register your company, register your business. You need to sort of separate yourself from the person that's been working the business in their garage, out of their car, to establishing a formal entity. And you do that through a filing with the Secretary of State. That filing requires that you submit an operating plan. It requires that you register as you have a registered agent, a registered person that's responsible for the business. It's a very simple process. It's not an expensive process, but it's to your benefit. The registration of your business marks the day that your business has started. When people ask you, how long have you been in business? It is that date. In a verification process from a bank, it is that date that they look at as your business, as the startup date of your business. Almost simultaneously, as you're registering your business, you should open up a bank account. You should start separating yourself, your personal bank account, your personal funds from your business funds, and you should start developing what we call a business credit profile, separate from your personal business profile. So you may be using your credit card, you may be using your own checking account to run your business. It's time to get a business credit card. It's time to open up a bank account with the business name, and it's time to start developing a credit history, a bank rating. A bank rating is based on how much money flows through that business account, that business bank account. You need to take time when you open up that bank account to select a bank that meets your needs. You have to ask questions. What is it going to cost me to do business with, what is it going to cost me to have a collection account? Do you do SBA financing? Not all banks do. If you're thinking about going down that SBA route, you want to make sure that the bank that you're establishing a relationship with has that capability to do that. If you're in retailing, do they have a niche in the retailing space that will serve you as you start that credit relationship with the bank? So that's opening up a business bank account. The next thing, you should really start getting your tax returns in order. And a lender is not just going to ask you for your last year's tax returns. They're going to ask you for tax returns as far back as your business is old. So if you've been in business for multiple years, expect to be asked to present your tax return for the last 3 years. The tax returns are a verification of what you have declared. Most of us would like to think that if we're in business for ourselves, we can do a lot of business off the books, and that's nice, and could be very profitable, but that's not going to count. It's not a conversation you want to have with the bank that says, hey, my tax returns don't really show my true profitability. I make a lot more than that. And that's not the image you want to present. So think about that as you do your tax return. You could very well be saving on taxes, but at the same time, you're selling yourself short when folks look at that tax return to verify exactly what your business is doing. Record keeping. Record keeping is extremely important. And we're very fortunate in today's world with all the software alternatives. The fact that software is very inexpensive these days. Software could very well replace the need for a bookkeeper. You use this software to start developing financial statements. You develop, you subscribe to different types of features that are in the software. So for example, you subscribe to a receivables feature that gives a lot of detail regarding receivables. If you're thinking about doing what we're going to be talking about in a little bit, which is basically factoring or invoice financing. If you're doing inventory financing, if you anticipate that the bank is going to finance your inventory, you should be focused on getting a module in your software that gives you a lot of visibility to your software, to your inventory, excuse me. So software selection will simplify things for you. You could virtually do it yourself by inputting your expenses in a manner that the software automatically lines up your balance sheet, your profit and loss statement, and your cash flow statement. Very important. It also adds to the credibility. It adds to your credibility when you're talking to a lender to be able to present financial information that's in a form that just has that professional look to it. And that's what software does. Last point I'm making here with respect to what you need to consider is a business plan. You have to have a business plan. It is not sufficient to go to the bank and to tell your story, as well as you may be able to tell the story. At the end of the day, someone's going to have to communicate that internally, and the way they want to do that is by basically having it all written down in what is called the business plan. The business plan will have your numbers in it. You need to know your numbers. You need to know your pricing, your margins. You need to know your market, the cost structure. You need to address that. You need to lay out your strategy. How you're going to address the market, what differentiates you in the marketplace, what makes your business profitable. You need to be thinking through what your future capital requirements are to fund your growth. And that may be a reason why you're asking for the financing, is you need the financing to grow the business. And you need to, as well as you may need the financing to purchase a piece of equipment or to purchase inventory. This all needs to be laid out in your business plan in a way that it's logical and it's clear to the reader, and it avoids you having to repeat that over and over again. It also is, as I said, the document that transmits the message through the financial institution, through the credit process. Moving on here, what will lenders be looking at? Lenders will be looking at what we call your lendable strengths. And your lendable strengths are the C's, the 3 C's of credit, and I'm going to go through here. The first C of credit is your credit history. Your reputation. Your credit history is your reputation. Hopefully, as you develop your business, you will be developing a business credit report. Dun & Bradstreet is one of the more known ones. That will summarize how you deal with your suppliers, how promptly you pay your bills. If you don't have a business credit report, the lender will be looking obviously to your FICO score. But your objective here is, again, same way you're going to register your business, you're going to open up that bank account. You're going to at the same time look to see what you need to do, make sure that your business is registered with one of these business credit report agencies. Again, that's a fundamental step. First C of the 3 C's of credit. The second C of credit is capacity. Your profitability. Lender will be looking at your business, at your profitability, and they will see whether or not your profitability, your cash flow, is sufficient enough to service the financing that you're looking for. In other words, they will tailor your financing will be somewhat tailored to what you can afford to pay. So if your business can't afford $1 million worth of debt, maybe perhaps your business affords $500,000 worth of debt. The way that they assess this is by doing what we call a cash flow to debt service ratio. And the benchmark tends to be 1.25 times or 1.5 times. In other words, you have to have sufficient cash flow after all expenses, sufficient to cover your interest expense 1.2 times or 1.5 times. That's pretty much a standard across across the business world for the debt, cash flow to debt service ratio. Third C of credit is collateral. There isn't a banker in the world that's not going to look for security wherever they can get it. When you hear about people getting unsecured debt, that means that they have a rather significant business with significant scale that allows them to basically get a loan without having to put up collateral. In most cases, you're a startup situation. You're going to have to post collateral. You may be asked to put up your personal guarantee. If you have any assets in your business, you will be asked to the banker will want to put a lien on those assets. If you're dealing with receivables, as you will describe in a couple of seconds, you'll find out that they're going to file what they call UCC filings, which effectively are liens that are going to be put on your receivables. And this is very common. So you can expect that conversation with your lender in terms of what security is available to give the bank that extra level of comfort that they need. Same sort of concept as collateral is capital. It's unlikely that you'll find a lender prepared to finance your business, give you a loan if you have no equity in the business. Equity means you or someone else has put hard cash in the business. And what that is there's a cushion there. There's a cushion of assets. Assuming that cash has created assets, it's created something on the asset side of the balance sheet, that equity is effectively a cushion to the bank. There are many banks that when they give loans, they'll want to have a lien on your equity. They'll want the shares of your company. They'll want to be able to take over your company if, in fact, you don't repay back the debt. You need to be very careful about that. You don't want to encumber that equity, but just by having the equity there, the bank will feel comfortable. The bank will, in the loan agreement, the bank will prevent you from decapitalizing the company, which means from taking the equity out of the company by declaring a dividend, by returning that equity prematurely before the debt is repaid. So capital is an extremely important concept, and as I said, unlikely that you're going to get a loan without having some capital or some skin in the game. Unfortunately, skin in the game is not on the balance sheet, but it should be part of your story. How many years, how much time have you been working the business without taking a salary in the business? That's skin in the game. That's sweat equity, as we refer to it. And finally, the conditions. Conditions are very important. When you get your credit approved, there will be conditions in that approval, conditions as to how the funds can be used, conditions on requirements that you will have in terms of reporting back to the bank, covenants. As I said earlier, you may not be able to pay a dividend. You may not be able to pay anybody any profits. You may have to leave your profits in the business until such time as the debt is repaid. It's a negative covenant. That's very typical, especially in situations where you're starting up. You don't have the scale, as I said. You don't have the large equity cushion. You're starting out. That's going to be an area of focus for the bank. Okay, so these two slides these two sort of what do you need to do before you start looking and sort of what your lendable strengths are. It's basically what we covered last week. These are the fundamental building blocks that you need to keep in mind as you approach a lender and as you seek to secure the financing. All right, so let's start talking about the spectrum of financing alternatives. This slide here, what I want to show you here is, before I get into the specifics of the three examples that I'm going to be going through, I just want to give you a broad perspective. You start off with a business. Businesses are defined as early stage businesses and mature early stage businesses. And you have the spectrum of financing. You start off with equity, which is you first take equity to run, to start your business. There's an area that exists, which are the grants that we talked about, like the SBA, or getting a loan from a nonprofit, or a grant from a nonprofit, getting a grant from an economic development organization in the state or in the community. Then you have the transactional debt that I will talk to, and then you have the bank debt. As you go from equity to bank debt, the requirements get more restrictive. It's difficult. The hurdle starts getting higher in terms of what the requirements are to do that. So when you're looking at equity, we define equity as being the sweat equity that I mentioned, your money. I would consider even equity to be the business card, a business credit card that you have taken out that is probably guaranteed by you. Now, I would consider that to be equity. So in your own personal money, your own second mortgage on your house, this is your money. Other people's money, there are a whole host of different types of investors that you can bring into your business. Crowdfunding, venture capitalists. There are many ways to skin a cat in terms of finding someone who is interested in becoming a partner with you in the business. So that's equity, and that I think it's a difficult process, but it's probably somewhat easier, I think, than sort of asking someone to give you, a bank to give you money. And it's a fundamental requirement before you go to a bank. Second category that I mentioned are grants. This is sort of economic development grants that are available. Again, if you have a business that addresses a specific social need, perhaps you're eligible. There are people that can help you with this, that you can tap into, that know how these programs work at the state level, at the local level. The nonprofits are very typical of how these grants are issued, is by working through a nonprofit. Nonprofits typically have corporate sponsors. Those corporate sponsors provide capital to the nonprofit. The nonprofit then looks for opportunities to distribute that capital through grants, and that may be something that may be available to you. I put in the category of grants the SBA. The SBA is typically, would be debt, but the SBA, the government guarantee, is effectively a form of subsidized financing that's available to you. Remember, the SBA doesn't lend you money. The SBA is guaranteeing a private bank who is lending to you. So you typically go to your private commercial bank that has a department that handles SBA financing. They are the ones that package your request for the SBA guarantee that then makes the financing possible. And again, SBA would be interested in something that economic activity in a specific area that your business may be operating in. Perhaps your ethnicity, perhaps it's the social impact of your business. These are things that get the SBA very interested in supporting small business. Transactional debt is what we're going to be talking about. And I say transactional debt are invoice financing, receivable factoring, purchase order financing, and inventory financing. And as I said earlier, the reason why I call it transactional is because the monies that you're getting from the bank are tied directly to a specific invoice, a specific receivable, and it automatically is self-liquidating when that end customer that you've made the sale to pays the receivable. Those monies go directly to the lender, and then the process starts all over again with a new advance for new invoices, new receivables. These are revolving lines of credit, revolving structures. Purchase order financing is very similar in that they're financing from the moment you make the purchase, when you place the purchase order with the supplier, all the way through final payment from the customer. The last category that I have here is, and this is really, you need to be a mature business. I would say a couple of years of business, a profitable business, to convince the bank to give you a bank loan that's tied maybe to working capital, your general corporate usages, maybe something tied to a large acquisition of equipment. But again, this is probably the most mature stage that your business needs to be on in order to be eligible for these types of advances. We have revolving loan, be it a term loan, be it an asset-backed loan. Asset-backed loans are basically loans that are guaranteed with a specific asset, be it a piece of equipment or your inventory in your business. So this is the spectrum that you need to keep in mind as you move from early stage to a more mature business. And these are sort of the areas of financing that you can focus on as your business grows and as you become eligible for each of these categories. Okay, moving on. What is invoice financing and factoring? Different names: invoice financing, sales ledger financing, factoring. They're all the same, and they're all the same in variations, which I'm going to get to. But by the bottom line, they're all the same. You're borrowing against a sale. You're borrowing against an invoice that you're generating with a customer. You're borrowing against a receivable, an IOU that a customer has with you. So the bank looks at it, the lender looks at it as a specific piece of security that they can make an advance against that will be repaid when your customer pays off that receivable or pays off that invoice. So that's what you're doing with it. And there are two forms of it, as we will get into here. Between, there's a minor difference between invoice and factoring, but that's basically what you're doing. The cost associated with this really depends on how the deal is structured. For example, if a third party, if a factoring company is collecting from your customer, if they're doing that collection, they're going to charge you what is called a service level charge. It's a flat fee for basically the collections function, which you otherwise would be doing, but because you sold the receivable to the factor has then taken over that service, that collection process from your end customer. So obviously, depending on the program size you have, you're going to have to pay a flat fee for that. On top of that, you are also going to be paying the cost of money, the financing charge, the interest charge associated with the cost of money. So keep in mind, this is not cheap financing. When you put these two factors together, it could be expensive financing. You could be paying north of maybe 20% APR. This is credit card money, basically. This is very expensive financing, but nevertheless, it is liquidity. It is a form of liquidity, and if your business can support that, it's there. It's there for the taking. Borrower profile. What does the business have to look like in order to be eligible for this type, or in order to fit into this alternative of financing? Typically, it's a financing that's available to B2B businesses or B2G businesses. That is business to business or business to government. That's the optimal profile. The reason why that's optimal is because at the end of the day, the risk in this financing is the payment, the risk associated with that payment, that your customer not making that payment. If your customer is a business, the likelihood is that they're going to make the payment, more so than if your customer was a consumer. If your customer is the government, there's a very strong likelihood that you're going to get that payment. It may take time to get that payment, but the risk associated with the government paying its invoices is very low. It's much lower than say the business paying off the invoice. So this business to business or business to government is critical. The optimal situation here is a reseller. If you're a small business, you're buying a widget, you're then turning around and you're selling that widget to someone like Walmart, which is of extremely good credit. This type of financing will fit that situation very well. Doesn't have to be a Walmart. It can be someone smaller, but that's sort of like the classic example of it being a no-brainer. You're taking a piece of furniture, you're taking a product, and you're reselling it directly to someone who is very creditworthy, has a very good reputation. The bank is more than happy to give you an advance against that sale. So the credit status and the reputation of the customer is extremely important. Your receivable aging is also very important. In other words, you need to show the lender, when you're looking at invoice financing and factoring, you need to show them that your portfolio of receivables, your portfolio of invoices, and your end customers are of the right credit status and the right reputation. You need to have an aging of those receivables to make sure that, you need to show them that consistently your aging is up to date, that you don't have anybody in your receivable pool that you want to do this financing with that is a non-payer or a slow payer. You want to make sure that those receivables are your best receivables that you're presenting to the bank, and you do that by having, as I said earlier, in your financial system, a report that can print out the receivables, that can show what the aging is, so that somebody can have clear visibility into who your customer base is. And by the way, there's a significant amount of due diligence associated with this. I mean, the bank will be looking at your customers one by one, and the bank will be requiring certain things. Depending, they may require for you to open up what is called a lockbox at the bank, where the payments from the customers come directly into that lockbox. That's how they manage the risk. They make sure that at the end of the day, the advances that are being made to you are eventually being used to repay. The collections from the customers are being used to repay the advances that have been made to you. You have, consistent with what I said about the reporting is you have to have a strong receivables management system. You need to, we touched upon that last week in the working capital module that we talked about, where you need to pay attention to your receivables. You need to make sure that your collections run smoothly, and that that obviously is reflected in the metrics, your aging metrics that you have in your financials. Okay, there's a difference. There's a fine difference between invoice financing and factoring. And I'll explain that with two charts. The first chart that I have here is what we call invoice financing. Okay, so point number one, you make a sale. You make a sale, you generate an invoice, you create a receivable. The lender, upon making that sale and receivable, and obviously this will be done on a portfolio basis. You're not talking about just one invoice. You obviously would come to an agreement with the lender that you're going to be doing invoice financing. You develop what is called a program. You define a volume, a level of advances, say be it $500,000 or $1 million worth of advances that are going to be made and are going to be within this facility. The receivables have to be of a certain type, the sales have to be of a certain type, and that sort of develops. That is what we call the program. But basically the way it works is you'll generate the invoice, and then the buyer will pay you. In this case, unlike in factoring, the buyer pays you, the seller. You then take those proceeds and you pay back the lender. It's a very straightforward process. Assuming your buyer is a qualified customer to the bank, they basically would be willing to give you an advance on the basis of that invoice or that receivable that you have with that buyer. Like I said, you perhaps may be required, instead of the monies coming directly to you from the buyer, you may be required by the lender to set up what we call a lockbox, which means that the buyer makes the payment directly into the lockbox. The lender then collects its interest and gives you the difference, basically. Now, the lender, as I said in point number two, the lender is not going to give you 100% of the invoice value. The lender is going to give you maybe 80 to 90% of the invoice value, so there's going to be a buffer there that is going to be used to pay off the interest and to pay off whatever service level fees are associated with the program. But at the end of the day, you're going to get the net proceeds of that. Now, to do this, you need to have a profitable business. You need to be able to absorb those costs that I referred to earlier, be it that service charge cost or that interest charge cost in this. Factoring is basically the same concept, except that in factoring, the lender, otherwise known as a factor, is purchasing the receivable. So there's a legal difference between invoice financing and factoring. In invoice financing, the receivable remains to be your receivable, remains to be the seller's receivable. In factoring, there will be an agreement where you sell that receivable to the factor. So now the factor owns the receivable. The factor does that, and perhaps maybe does that with non-recourse to you. So if the factor doesn't collect from your customer, for some reason your customer doesn't pay, you are only obligated to return the money that the factor advanced you. You're not obligated to return the entire invoicing amount to the factor. So there's a fine difference there, a fine legal difference where the factor becomes the owner of the receivable. The factor is effectively the interface, directly with the customer, interfaces directly with the customer to receive payment of that receivable. So the sale creates the receivable, the factor purchases the receivable, and advances you, again, rule of thumb, 80 to 90% of the receivable amount. The buyer pays the factor 100% of the receivable amount because they are now the owner. The obligation of the buyer is advised that receivable has been sold from you to the factor. You have to keep this in mind. This could impact the way you do business with your customers, but you need to keep that in mind. So the buyer is advised that receivable now belongs to the factor. The buyer basically then pays the factor directly. The factor then discounts the various costs associated with the program, and you receive the net proceeds. So that's a fine difference, the fine distinction between invoice financing and factoring. In my mind, they are both the same. It's a matter of form over substance. The substance is that you're using your receivable invoices to obtain financing. The form is obviously the legal form as to whether or not that receivable remains your receivable until payment is made, or whether that receivable belongs, that receivable belongs to the third party, the factor. There's another variation on the same, except it goes further downstream, as we say. It touches upon the supplier, and that's what we call purchase order financing. In purchase order financing, you're borrowing from a lender to not only are you releasing funds from the receivable you've created. In purchase order, you're borrowing to pay your supplier. So you're getting a loan, you're getting an advance from a lender who is giving you money so that you can use that to pay your supplier, to then have that product delivered to your customer. And then when your customer makes payment for that product, those funds get returned, those funds get paid directly to the lender, and that's how the transaction unwinds itself automatically. So what you're doing here is you're borrowing to fund the supplier, and you're borrowing to fund the receivable. So you have two components here that come into play until the customer pays the receivable. There's no sales history required when you do this. These tend to be one-off type of deals. They tend to be, if you're doing business with Walmart and Walmart wants you to buy $1 million worth of inventory for a program you're doing with Walmart, this is the type of financing that would be appropriate for that. You would find someone to give you the cost of that product, that $1 million product that you're going to sell to Walmart, and it's all part of one package. The lender obviously wants to see what your business is. They want to look at your business to make sure that everything is profitable, everything is set up properly, but they're not really interested in any other business that you're doing. They're focused directly on the supply, on the purchase order that you have with your supplier, and on the sales contract that you have with your customer. That's what they're focused on. In this case, you're administering it. You're administering placing the purchase order. You're administering the logistics of getting the product to your supplier. There really is very rarely do you see a service charge. There may be some fees involved, but in this case, your cost is really the cost of money. Cost of money being the cost of money plus a credit spread that the lender attaches on top of the cost of money. This type of financing is best suited for retailers. Going back to my Walmart transaction, or if you're dealing, if you need to buy lumpy, large, equipment or products that eventually you resell to a large customer that has a good reputation, that is creditworthy. This is the type of financing that serves that purpose. It tends to be easier to put together than invoice financing. And I would say it's an easier deal to do than factoring, because it is the entire transaction that the lender has visibility to and gets comfortable with when they're looking at this. They're getting comfortable with your relationship with the supplier. They're looking at that purchase order. They're looking to make sure that the supplier can deliver the product that you're buying from them. And once they get comfortable with that, and once they get comfortable with the customer, everything seems to flow pretty much seamlessly without any real interference. You're running the transaction for the lender, but the lender has recourse to your purchase contract and recourse, obviously, to your receivable with the customer. Let's go through some of the just to reinforce what a purchase order process is. You receive a sales order from your customer. You then receive a quote from your supplier. So when you receive the purchase order, you then have to go out and maybe find the product that you're going to sell to your customer, or you have an existing relationship with a supplier. So you receive a quote, which is really a purchase order that you're discussing with your supplier. You then take your sales contract from your sales order and your purchase order, you turn those documents over to the lender. The lender, as I said, is going to scrutinize who the supplier is, going to look at the terms and conditions of how you bought the product, going to look at basically the risk associated with your supplier not delivering the product. Assuming they get comfortable with the fact that your supplier will deliver the product, they are more than happy to give you the advance, typically 100% of the purchase order, to be able to buy that product. At the same time, they're going to be looking at your sales contract to see whether or not there's anything in the sales contract that would allow your customer, for example, to walk away from the sales order. So that's where the due diligence is happening. This is where the underwriting, this is where the risk assessment is. This is where the back and forth is with the prospective lender that is looking at purchase order financing. Financing company will pay the supplier directly. In other words, the funds are not coming to you so that you can pay the supplier. They will feel comfortable with the supplier enough where they make the payment directly to the supplier. The supplier then delivers the goods to the customer. Customer then pays the financing company. And then at the end of the day, financing company will send you the difference. In other words, financing company will send you at that point in time your profit in the transaction. So you'll get a profit less the interest associated with it. Again, this type of financing requires that you have profitable business. This is not something that you can do with margins of, say, 5%, with margins of very minimal profit margin. You really need to have a situation where you're exploiting an advantage that you have to purchase something and really benefit from and enjoy a rather significant margin with your end customer. That's really the type of all of these options, be it invoice financing, be it purchase order, be it factoring or purchase order financing. All three options require a very profitable business. If you get into this and you do not have a profitable business, you'll just be digging a bigger hole for yourself as time goes on, because you'll never be able to really catch up with the cost associated with it. You'll sort of be behind the eight ball, as we say, on an ongoing basis, on a revolving basis. That's very important. Some common pros and cons, again, to sort of to review what we just discussed, going through the examples. Your personal and business credit here is less important than the reputation and the credit of your customers. This is what makes it attractive for a young business. If you're not a mature business, if you have a very short history of being in business, but you have these very profitable sales that you're making to reputable customers, good credit-worthy customers, i.e. the Walmarts of the world, and you're dealing with a reputable supplier, this is the perfect financing tool for you because it requires no real history, and the lenders are looking specifically to the transaction at hand. In that regard, it tends to be a bit more flexible than a traditional bank loan. It tends to be more tailored to what you actually need. Most people are financing the growth of their business. If someone presents you with a very attractive sales opportunity that requires a significant amount of capital, i.e. to buy that supply, to be able to deliver to your customer, this is the type of structure. These types of structures work very well to do that. Opportunity to outsource your credit function and receivables. As I said, the lender is looking at their customer base. They're making an assessment as to what the creditworthiness of your customer, the reputations of your customer. If you decide to do business with that customer after hearing from your lender that customer is not acceptable to them for whatever reason, then obviously you're deciding to, maybe you're deciding to take more risk with your customer than they would be prepared to take. But obviously, if you do this on a program basis, you could literally say, hey, I will only do business with customers that effectively qualify with my invoice financing, factoring, or purchase order financing lender. So as an opportunity, it's going to cost you that. Obviously, that costs money because that's what that service level that I referred to in that slide really is. You're paying that service level charge effectively to do your credit function and your collections function. The cons: difficult to arrange for a business that is dealing with consumers. If you're selling your product to a consumer, if you have a shop and you're selling to customers who are walking in from the street, unlikely that these alternatives are going to work for you. So business to consumer businesses, this is not a product that works well. As I've said, very expensive. You need to be, the businesses you're doing needs to be very profitable business, and that's the quid pro quo. You have a young business, you're not eligible for a working capital loan per se. Yes, you can come in and do these working capital type of loans, but basically, you're going to have to pay the price. I would not say that these financing alternatives are as expensive as credit card debt, but they're pretty much in that same neighborhood. But again, you may have a quality customer that makes that cost lower than your normal credit card cost would be. That's really why it's very good for businesses that are doing that. It's very good for a customer base that is reputable and high and very creditworthy. Again, you need to have the underlying support in your management systems. And the invoice financing, where the factor is where the invoice remains in your possession, you need to have a system in place to show the lender that you are collecting efficiently, that you're watching the metrics, that you're watching late payments. So keep that in mind as you're setting up your software, your financial software. If you plan to take advantage of these alternatives, you should have modules in there that give you visibility to how the payment of your receivables is performing over time. One important issue here, and this is something I've learned over the years in doing a lot of financing for companies with their customers, is that there's an inherent conflict. I call it the inherent conflict. There's a conflict between you being a business person, developing a customer relationship, getting on the good side of that customer, convincing that customer that they should be doing business with you, and a financier, like a factor, whose interest is making sure that they get their money back. So if you go into a factoring program and you literally are selling your receivables to a third-party lender, there's a possibility that third-party lender will be having discussions with your customers, which may interfere with the relationship that you are trying to develop with that customer. bottom line, you're losing control. You're losing some control over your customer when you introduce someone who has got a lien, who has a right to talk to your customer, to collect from your customer. You're losing a little bit of control there. You need to be cognizant of that. Now, there's nothing wrong by telling your customer that you're doing purchase order financing to fulfill their order. There's nothing wrong with telling your customer that you're using financing from a factor, or you're doing invoice financing, but you just need to be aware that if there's a repayment issue that comes up with your customer, you're going to lose control over how you want to have that discussion with your customer. In factoring, your customer will acknowledge that they no longer owe you. They owe the factoring company the repayment of the loan. So that that'll be very clear, very black and white to the customer. There'll be liens. There'll be liens on certain payments from certain customers that you need to be aware of. So if you're in one of these programs and you decide that you want to get a loan from a bank to finance equipment, you'll need to be aware that these lenders may have put liens on all your assets. So you need to manage how the liens are filed. You need to make sure that the liens are very specific to the receivables, or very specific to certain customers, so that they don't impact your ability to do other things, other financings that you may have in mind with, that you may need to have your assets free and clear of liens in order to move forward. So that's basically it in terms of pros and cons. I hope that this has been helpful, and I just want to just kind of go through this final slide with you again. This slide earlier, you see where that fits in the spectrum of alternatives. You see where this transactional bank debt fits in. And you now see, maybe I hope I made it clear that it's not as stringent as bank debt would be. But it's not as easy as, say, a grant would be, or perhaps equity. It's in this spectrum. It could be a viable alternative, in terms of generating liquidity for you, with the caveats that we've put forward. In other words, with the fact that you really need to have a good customer, and you really need to make sure that you can afford this type of financing. So with that said, Jenny, how are we doing on time?
That's great. We still have 6 minutes to chat, so we'll do rapid fire questions here at the end.
Rapid fire questions. Very good. Very good. I'm sorry if I went over.
No need to apologize. It was really great. You guys, most importantly too, he was kind enough to leave his email address and contact info here. So listen, it's in the chat right now. It's also up on the screen right now. So even just take a screenshot of it, jot it down if you have any questions, because I think it can be a lot to take in, almost to the fact that where somebody's not, super savvy with finances, it might be like, oh, let's just block it out. But the truth is, we have to immerse ourselves in this if we're going to move forward business-wise, et cetera. So you were talking.
And if I may add, as when you introduced me, part of the reason for me wanting to do this with Sir is that I'm looking for an opportunity to give back. I'm looking for an opportunity to help people that are starting their businesses. As we said earlier, I'm retired. I play a lot of golf, but I would also like to keep busy. And I think that if, I'm very open to you coming to me with your problems, not your problems, but with your situations where we can maybe work together, and I can maybe be some value added to you achieving what you want to achieve.
Yeah, that it's so great and so generous, and you know what, I will, just so that you feel the love right back. Somebody just wrote in the chat, this was an excellent presentation, the most thorough I've heard in decades. And they're saying thank you so much for going over it, because
finance people tend to be detailed oriented.
Well, it's good, because then there's creatives coming in here and we're not, and it's great. Now, we were talking at the beginning about this record keeping profit loss, that it needs to be organized, right? When you go to get your funding. What if you're like, I've just been kind of taking clients here and there, selling stuff here and there. It's not very organized. Do you need to wait to go to try to get funding until you have a certain amount of, records under your belt, so to speak?
You need to purchase, for as little as $49 a month or even less. You need to purchase QuickBooks or there may be 10 or 15 products out there that you set up on your computer to be able to insert your bills, to be able to record your sales, to be able to record your receivables, etc. In fact, it's all done very, it's all automated. And in fact, it may even save you time and maybe save you from having to have a bookkeeper come in once a week to do that. You can actually, and a lot of the software is online. It's mobile. You could start doing this on your phone, and just start developing, and automatically from just inputting your costs and inputting your sales, automatically it will calculate your profit and loss. Automatically it will calculate your balance sheet. If you make a sale and you say, I'm not going to get paid in 30 days, it will create the receivable that's on your balance sheet until such time as you input the fact that you've collected that receivable. So that's just the way that it works automatically. But the software, I think, is extremely important because it makes you look, it formalizes the process of you presenting to a lender that this is my profitability. This is how I keep track of my profitability.
It just seems a little bit more legitimate.
Yeah, exactly.
Okay. And QuickBooks, like, listen, you guys, I mean, I've even done QuickBooks. If I can do it, anybody can.
And by the way, QuickBooks may sound like a Mickey Mouse type of software, but it is not a Mickey Mouse. There are many large companies that operate on these softwares. Yeah. Not every company out there is using SAP or is using Oracle. I mean, a lot of them are using these are all Intuit type of products. There's a lot of large companies that are still using QuickBooks. But QuickBooks lends itself to the smaller business as well as to the larger business, and you can buy the services that you need. If you need an inventory module or you need a receivables module that is more than what the standard is, then you can buy that and you can tack that onto the package. And they're also there to help you. They also provide customer support, which could be there to help you set it up and even help you run it without the need to hire a third party, a bookkeeper, to come in and run it for you.
That's great. You know what? This has been such an informative session. This was great, and so we're hoping Jose is going to be back at the conference coming up. Hopefully, that will all work out for him to be back. And I will just wrap up by saying, again, you guys, his information is in the chat. He was kind enough to share those details. So even if you were like, I was intimidated to ask a question in this forum, he's there. He has 40 years of experience in this in so many different aspects. And, gosh, I mean, I love that you laid out some different points of financing that some people would say, avoid it altogether, but we have to know what they are in order to know if they're an option for us. So I really appreciate the time.
Great. Thank you. Thank you, Jenny. Thank you for those comments. Appreciate it. And thank you to all for listening. And again, I hope to hear from you.
Yes.
All right. Cheers.
Cheers, everybody. So don't forget, Creating Gateways to Economic Equity, May 10th at the Hilton Dallas Plano Granite Park in Plano, Texas. It's the 59th annual conference. It's something that we will all be looking forward to. And also, if you liked today's session, and I know that a lot of you are really hanging on to every word, the replay of last week's session is out on YouTube, but the link is in the chat. So grab it really quick before we close this session out. And I will see you all next Thursday. Bye, everybody.
Bye-bye.